Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap with my good friend Lance Roberts. How are you, Lance?
I'm fine. We should start doing a blooper reel after the show. So.
If anybody knew how long it currently is. All right, Lance. Well, look, a lot to talk about. Full disclosure, we're recording this at the end of the day on Thursday because I have to be traveling on Friday. So thanks for making yourself available, Lance. So folks, we are missing the last day of the market here. We'll catch you up on it next week if anything super material happens that day. But Lance, there's a lot going on right now. So right now we're really kind of watching this battle for the daily market average. The past couple of weeks, you'd been pointing out for us how there are many daily moving averages that have converged kind of at the 3,900 level. Yeah. And when we talked last week, it looked like we might have broken out of that. The market was up to about 4,000. It's since dropped back down, and now there's a real just boots in the mud, military back and forth on this line of demarcation here. Right. So tell us what's going on, and do you have any sort of intelligence that leads you to think it's more likely to break more one way than another?
So a couple of things. First of all, so we actually did break above the 200-day moving average for a couple of days. And so that was kind of positive, but we did not, and this is the big differentiator, we did not get above that downtrend line that runs back to the highs of January of 22. So while we made some progress technically, the markets rallied above the 20-day, the 100-day, the 50-day, and they're in this order, by the way, and the 200, and we got above the 200-day moving average. So that's all very bullish, right? If you take a look at a chart of the S&P 500, there's a very nice rising trend line that comes off the October lows. So if you connect the October lows to the December lows to where we are now, we've got this rising trend line. At the same time, you have this detrending line of highs going all the way back to January 22. So what you have is a compression now within prices. I can give you an exact date, February the 17th. We will know for a fact by February the 17th which way that this market breaks out. Now, it could happen sooner, but it will definitely happen by February 17th. How do I know that date? Well, if you extend these lines, they intersect on February the 17th. I don't even know what day it is. I don't even know what day that is. That might be a Saturday. I don't know what the 17th is. But when you drag these two lines out, they intersect at that date. So the market has to break out of this consolidation in one direction or the other. Whichever way, now you think about this, the way prices work is it's like a spring. And when you start compressing prices into a very narrow range, when they break out, that spring is going to decompress. Either the market's going to move up sharply as shorts have to start covering very rapidly, or the market's going to move down very sharply as people start shorting the market, right? So it's going to break in one way or the other. Which way is it going to break? I don't know, right? So, but what happened, and again, to your point, we're talking here at the end of the day on Thursday. So where we are right now is we technically have a failure at that downtrend line. The market came down, tested the 50-day moving average. That's where it closed on Wednesday. On Thursday, we broke a little bit below that. Now, the market's been recovering all afternoon, and we're kind of looks like we're going to try to get back to break even by the end of the day. We'll see. But where the market is working with right now is the 20-day moving average has crossed. I know this is a lot of technical mumbo jumbo. Just hang in there with me for a second, okay? The 20 days crossed above the 100 days. So all that's doing is providing a floor to these prices. So when you have these moving averages that all come together, it just provides support, because this is where markets have traded now over the last 20 days, last 100 days, last 50 days, last 200 days. So that's all these moving averages tell you. They just kind of give you an idea of where buyers are and where sellers are. And right now, there's a lot of buyers sitting at that 20, 100-day moving average crossover. So when we got down there on Thursday morning, buyers showed up, started buying stocks. And so that's where we are within this market. We're still working this consolidation pattern, and whichever way that breaks out, that's going to be a reasonably good trade, at least for 2 to 3 to 4 to 5 weeks, following that breakout, whichever direction it goes.
Okay. So as you said, we will know definitively which way it's going to break out in about a month, based upon the convergence of those two wedge points.
Right.
But obviously it could break out.
Yeah, it could happen tomorrow, right?
Exactly. It could break out much before that. Yeah.
The very last date of this, though, is going to be February the 17th. So,
okay. So obviously we'll all be watching closely. And when it breaks out, you generally think in whatever direction it breaks out, we're going to get several weeks of momentum in that direction afterwards. And so I'm sure you're factoring that into, where you want to deploy capital. Okay. So question for you about the recent past, where we did, it looked like we might be breaking out and then we came back down. There's some data out there that suggests that was a short squeeze was an important contributor to that. And you had, I think the most shorted stock index had risen for like 8 days straight, pretty aggressively. And then that has just recently reversed. And there's been a couple articles out in the past 24 hours saying, all right, short squeeze is over. That's why prices are now coming back down. And now the market's really going to find its true bottom. I'm just curious, how much truth do you think is in that sort of the optimism we saw over, say, the past week might have just been sort of a standard short squeeze instead of any particular, sustainable rally?
No, all these rallies are short squeezes. Every time you get a rally, the first thing it has to cover is a short squeeze, and that's why coming off the bottoms, they tend to be pretty violent. Because as prices start to rise, everybody that was shorting has to start covering their shorts, which fuels the rise. And so yes, we saw that. In fact, if you look at what stocks have rallied the most, I ran a screen the other day. I was just curious. And I ran a screen of stocks that were up more than 40% since the beginning of this year. There was 560 stocks. Now, this is out of every stock in the world, right? So, or in the U.S., sorry. It's every stock in the U.S., and I just ran it. So this is a lot. There's a lot of stocks out there that aren't in the S&P 500. But anyway, there was 560 companies that have rallied more than 40% since over the last month, right? 505 of them all traded less than $5 after the rally, which means that before the rally, they were somewhere around $1 to $2. And so, the point is that this rally has been by magnitudes of the worst fundamental shorted companies. And those are the ones that have been rallying the most. So when you take a look at Apple, Microsoft, Google, they're up. Amazon's had a nice rally here. Netflix is actually up 100% since its lows in October. But those companies didn't rally nearly as much as a lot of these junk stocks did. So it does tell you that this has been a low quality rally. But the thing we want to watch is to start to see if we begin to see a firming up of support in some of these bigger companies. If Apple and Google and Microsoft and Netflix and others, if that bottom in October was the bottom and we start to see a firmer setup in some of these companies, that's going to give us a little bit more credibility that maybe the bottom was in October. I'm sure we'll talk about some more here later in the show today, but there's a lot of reasons to expect we're going to have a pretty decent recession this year. So, whether or not the lows are in is debatable, and that has a lot to do with Fed policy and whether the Fed breaks something or not.
Right. And even, just how those companies perform going into a slowing economy. A couple of the companies that you just listed just this week announced that they are announced substantial layoffs this week, which is a sign that they're not totally flush, right? That being said, you do a really good job on this channel, Lance, of making sure that, especially of late, where we've had a lot of guests that have a relatively pessimistic outlook, of saying, hey, don't fall in love with your any particular thesis, and nothing's ever 100% bullish or 100% bearish. So you do a good job of keeping us balanced. I want to spend some time on the bull side of the argument right now. So
I'm very excited about this because I want to hear about your interview with Tom.
Well, that's where I'm going here, right? Partially inspired by your efforts, and also largely inspired by the Wealthion audience, who said, hey, look, we feel like we're getting a really good grounding in the bear case, but is there a bull argument to be made here? So to your point there, Lance, had Tom Lee on the program yesterday. For those who don't know Tom Lee is often referred to as the biggest bull on Wall Street. He's on CNBC all the time. Generally has had a very rosy picture of the market forecast for many years here, and to give him some credit, whether you ascribe to his particular brand of analysis or not, bullishness was called for in the markets leading up to the end of 2021. Maybe didn't perform so great last year. But anyways, brought him on the program to say, Tom, is there a bullish outlook here? He said, absolutely. And he is basically calling for at least his base case is a 20% increase in the S&P this year, though he reserves room for it to go higher, potentially much higher, he says. But anyways, these are kind of the main elements of his bullish thesis. And I'd just love to get your reaction to each one as we go through it.
Okay, so question, are you going to list them all at once, or are we going to go one by one?
We're going to go point by point.
Okay, I didn't want to talk over you, so go.
Oh, okay, all right, good, no worries. All right, so starting with the first one, it just says in general, the global economy has been a lot more resilient than we thought it would be. There have been some pretty big shocks that have happened over the past year. He said, I would expect Europe to be in a depression right now, but it's not. And so part of it is just, hey, the bears have been talking about how we're going into some massive, terrible recession, but it really hasn't materialized yet, right? In fact, we had, two pretty decent quarters of GDP ending 2022. So just from the get-go, he just says, I don't think it's as dark as everybody's painting. So I'll pause there for a second.
Okay. The problem with that point, and again, let me just, okay, you're asking me for my opinion about his comments, right? So
exactly. Yep.
I just wanted to preface every answer going forward from here is, this is my analysis of what's going on. It's not a prediction of what's going to happen, right? So this doesn't mean that, go hide in a bunker, right? So,
all right,
but
good caveat. Don't worry, you're good.
Okay, so here's the thing, though. Tom Lee wrote an article previously, and I actually wrote a counter article about it on our website. He made this case that this was Paul Volcker's 1982, and I wrote an article that said this is not Volcker's 1982. His premise is that as inflation comes down, the Fed's going to hike rates, reverse, and then everything's just going to go to the moon after that. Well, the problem with that thesis is that we're probably, if you believe that inflation is here to stay, we're in the first phase of inflation. In other words, inflation will come down and then it's going to ratchet back up again before we get through this inflationary cycle. And that there's some reasons for that, because if the Fed pulls off their brakes and starts going back to QE and dropping rates back to zero, that's a very good setup to reignite inflation. And that's going to be one of the concerns of the bond market potentially if the Fed pulls off off this gas too soon. But here's the other thing. Here's the other mistake that I think Tom's making, along with a lot of other Wall Street analysts. And we hear this all the time. So let's rewind the tape for a moment to August of 2019. And if you remember, in August of 2019, there were a couple of things going on. The first was, remember in 2018, the Fed's hiking rates and they're doing quantitative tightening. And then we have about a 20% correction in the markets. And Donald Trump gets all over Jerome Powell and he says, okay, I give. We're not going to hike rates anymore. We're done. So the market starts rallying in 2019. Everything seems to be okay, right? Everything's fine. And then in July, the Fed starts cutting rates because the yield curve is inverting. And everybody goes, well, the Fed's cutting rates and the yield curve inversion is happening. And I wrote an article in August, September about the National Federation of Independent Business saying, we got all the recessionary signs in the world. There was a recession coming. Everybody's like, there's no recessions happening. In March of 2020, we have a recession, a pandemic, global shutdown, everything. All the indicators were there, but nobody wanted to believe them because the attitude was, well, we had these events, but nothing happened. And that's not the way the economy works. The economy is like a windshield. And, if I keep throwing rocks at a windshield, the first few may bounce off the windshield as I'm driving along. And then a couple hit the windshield and it cracks the windshield. And a few more hit the windshield. And now the windshield spiders. And eventually the rocks are going to start coming through the windshield. That's the way the economy is. There's a momentum to the economy. And so as these events are hitting this momentum of the economy is slowing down from being impacted repeatedly by these events. And so while it may seem like in the short term that the economy is a lot stronger than it appears, it's not really. It just hasn't ground to a halt yet, but it's heading that way. And so, a good way to look at this about yield curves, if you go back in history and look at every yield curve inversion. So there's a lot of different yield curves. Which one are we talking about? The 10-year versus the 2-year. That's the yield curve we're going to use for this example. So if we go back in history and look at every period in history where that yield curve inverted, now here's the thing. We're looking for an inversion that didn't last for 30 days and then turn back up. That's not an inversion. That's a blip. If the yield curve was inverted for 3 months, how long was it before there was a recession? Now, first of all, 100% of the time there was a recession. So it's not a function of if there was a recession. It's if it was inverted for 3 months, there was a recession.
There was a recession. So
how many months was it? Well, it's on average about 19 months, give or take. Now, now where did our yield curve invert? Our yield curve inverted about 10 months ago. And we've been running an inverted yield curve now for about 10 months. So everybody do some quick math. I know this is Adam's show and we shouldn't be doing math here, but 19 minus 10 is 9. So in theory, if we stick to the average, now this is the thing about averages, right? It can be longer, it can be shorter. That's the thing about averages. But if we assume the average is correct, in 9 months we'll be in a recession. Now, everybody's going to be saying from now until then, well, we're going to avoid a recession. It's a soft landing. It's all these type of things. The problem with Tom's thesis, and again, he's smart. He's a much smarter guy than I am, but I'm just using statistics and history, is that, if we have a recession, that is going to impact the markets because markets will have to reprice for earnings and margins. And we need to talk more about earnings and margins, by the way, with Procter & Gamble's report that came out on Thursday. But earnings and margins will have to decline, which means prices have to fall to accommodate for lower earnings and margins. So that's my very short answer.
Okay, good. I want to get to earnings and margins because I did talk about that with him real quick. You mentioned this briefly, but a big part of Tom's thesis is that inflation's under control. Like it's on its way down. It is passing through the system faster than the Fed has been expecting, and that the Fed is going to get to a point where it's going to have to pause sooner than it thinks and maybe not do as many rate hikes as it thinks because it's going to be evident pretty clear that it doesn't need to, and that actually, geez, maybe we've already tightened too much here. And so he's really, of the mindset of like, yeah, inflation expectations are overblown. And once the world wakes up to that, that's going to be very bullish.
Right. Now that is a fair point. If you take, and look, this is one of my premises of the Fed breaking something, and has been for a while. But if you look at so when we look at inflation, right, we look at the annual change of inflation, right? So we look at inflation now versus inflation a year ago. The problem with that is there's, as you and I have talked about before, there's a lot of lagging data in there that takes a long time to catch up. Homeowners equivalent rent is a good one to look at. It's more than 30% of the index. It runs about a 3 to 4 month lag before it shows up. So strip all that out and let's look at the 3 month average. If we look at the 3 month average of the rate of inflation change, we're running at about the Fed's 2% target rate. So in theory, Tom is right. The Fed should stop hiking rates now. In fact, they probably went too far over the last probably 3 meetings. They probably should have stopped hiking rates. But there's only a couple rate hikes left. So Tom's right. The Fed's going to stop hiking in the next couple of meetings. Either they're going to stop in February or in mid-March or April, whenever the meeting after that one is. So, they're going to stop here very soon because they've already said that they need to pause to see what this lag effect of rate hikes are going to be. And again, here's another lag problem that we have with talking about the economy is 9 months, 19 months for an inverted yield curve to show up in a recession. there's about a 9 to 10 month lag before Fed rate hikes show up, which means that the majority of rate hikes that they've done haven't even showed up in the economy yet. So, there's just a whole lot of pressure on this economy at a time where you have consumers running out of capital, right? All that stimulus is gone. Inflation has gone up. Wages haven't kept up with the cost of living. So, this is all going to impact consumption and the economy, 70% consumption, which means economic growth is going to slow down, which is what the Fed wants, by the way. The Fed wants a slower economy and they want higher inflation. And what they're hoping, and if you'd like to kind of take a look at what should happen with employment, is that we should see the unemployment rate rise to about 5.6% unemployment. The problem with that is that we never just rise a little bit in unemployment. It's either really low or it's shooting straight up to the moon. So, this is going to be one of those issues where we may be at 3% unemployment now, and I'm not making a prediction, but we could be talking about 10% unemployment by the end of this year, depending on what happens economically. So,
right. And let's just to make a clarification. You said the Fed wants a slower economy, and you said it wants higher inflation. I think you meant higher unemployment.
I meant higher unemployment. Yes. So, thank you.
All right. So then moving on to earnings. So I asked him about earnings, right? And I said, okay, look, it does not seem that analysts have brought their 2023 earnings down enough yet to map what we're seeing here in reality. And he said, maybe, but he said two things. He said, earnings have already priced in some form of recession. And if we don't get the type of recession that I think we're going to get because inflation's more under control than it is and the economy is more resilient than it is, then actually it's all about what's priced in, right? And that, might turn out actually that even if it's bad, if it's not as bad as what's priced in, that's going to be bullish. The other thing he said, yeah, we're talking about 2023 expected earnings here. He said, but at some point in this year, we're going to start pricing stocks off of 2024 earnings, and we should be in recovery by then. So, for both those reasons, he sort of hand waved and sort of dismissed the earnings recession risk that you and I have talked about.
Yeah, look, it's a fair statement. And that's the way the markets do work. And the markets do price ahead based on what expectations are. Just this one caveat, though, expectations are always wrong. And we're seeing that right now. And, I track earnings every month when they come out. I update, and I have history of earnings going back years. And what you find is that analysts are always about 33% too high on their estimates at the beginning of the quarter, and then they bring those down. That's why I call earnings season that we're in now the millennial earnings cycle, because everybody gets a trophy because we lower earnings so much that everybody kind of gets over the bar. So that's the thing to remember. And so here's the problem with and this is why, honestly, if you're an investor, when anybody talks to you about forward operating earnings, you need to just kick them out of the room and go find something else to do, because here's the problem with operating earnings, and here's the problem with forward operating earnings. First of all, operating earnings are what we call bullshit earnings, because it's what we used to call pro forma. This is what I hope earnings will be, and if nothing bad goes. So,
right. If everything works out exactly magically how I want. Yeah.
Exactly the way I want. This is what it should be. And used to be back in the day. Now I'm going to show my age here, but in the last century,
you're going to talk about the prospectus, aren't you?
Yeah. When the 10K, 10Q reports came out, et cetera, for earnings, what we reported was GAAP earnings up front. Those are generally accepted accounting principles. That's what the 10Q earnings report was based on. It says, here's what we did. And the very back, on like the last page before the index and appendix, there was the pro forma earnings, right? And nobody paid attention to it. Well, we started figuring out that the pro forma earnings were always rosy and optimistic. And so we all started talking about that because it's so much better than what happens in real life on the balance sheet. And that helps elevate stock prices, and that keeps stock options in the money for executives to cash out. And this is the whole manipulation story we'll get into someday. But here's the problem with forward estimates. So here you are, you're an investor, and you call me up today, January the 1st, and you say, Lance, I'm going to go buy ABC company because based on forward operating earnings, the PE on this company is like 5. It's really cheap. So you go out and buy it. Well, then, of course, the company comes out, they report all the bad things that are happening to them, and their earnings don't come anywhere near reality of what the pro forma was. And what you find out is that 5 PE you bought is now 25 PE because of the earnings collapse, and you way overpaid for a stock. And this is the problem with forward operating earnings, because that E is never right. It's always overestimated. You always overpay for stocks using operating earnings. When you're investing, always use trailing earnings. Understand what you're buying is always more important. So, so the problem, the problem with Tom's thesis is this: have earnings come down? Yes, they have come down. I use the S&P 500 earnings. So I go to the actual S&P Global, which is the company that produces the S&P index. And FactSet has a different set of numbers. I don't know where they get their numbers from, but like their estimates are $230 a share for the end of this year, and S&P's at 180. So there's a $40, $50 gap between these two, and they're the same company. So you go figure this out. Anyway, I use S&P because they produce the index, so I figure that's the right one to use. But at $100 a share by this year, you are still over 2 standard deviations above the long-term growth trend in terms of. So if you're going to have an economic recession, earnings are going to have to come down to meet that value. And are you there? Mm-hmm. Okay. The problem is that we have a recession. We're still more than 2 standard deviations above the long-term growth trend in earnings. So earnings have to mean revert. If we don't have earnings and corporate profit margins mean revert, capitalism is broken. And that's just a function of how things work. And here's the important thing. So everybody assumes that we're currently running record high corporate profit margins. And everybody's assuming that we're going to maintain record high corporate profit margins. Okay, that's fine, except how did we get record high corporate profit margins? Back in 2020, 2021, we shut down the economy and we fired everybody. So now all these companies are running less employees, which cut what? It cut their most expensive item on their budget, which is their payroll expense. So now these companies are running lean staff, much lower employment, much lower payment of much lower, sorry, one more time, much lower staff, much lower wages, much lower benefit cost. All those things come down a lot. At the same time, we have an inventory shortage because of the supply chain lockdown. And that means that the goods that I have available for sale surge in price. So now I'm not producing anymore right now because the supply chains are shut down. My manufacturing shut down. The economy's down. So everything I'm selling is at a super high price, and I've cut my cost at my business. So now my margins have just surged to these astronomical levels that we've never seen before in history. So how do we maintain record high margins now when you don't have $5 trillion worth of stimulus to get people to go out and increase demand by 25%, when you can't increase production? You've hired everybody back. We're back to the same employment levels we were in 2019 pre-pandemic. So now the payrolls are full again. Wages have gone up because of the demand for higher costs. All that's eating into the profit margin. So how on earth are you going to maintain record profit margins if you don't have the same environment that you had previously? Like running an experiment. If you don't have the same variables, the experiment's going to turn out different, right? So this is the problem with the earnings and margin thesis going into the end of this year and into next year. Earnings estimates and margins are still way too high relative to what's going to happen economically through the course of this year as you have a recession and economic slowdown.
Yeah, that's a great point. You strip down the company, for a little while it looks great, but then the reality has to map to the resourcing that the company has. And you're right. I think way too few people are thinking that way. All right. So,
by the way, can I interrupt you real quick? Procter & Gamble, this is a great example. Procter & Gamble reported earnings on Thursday. They basically came in line on revenue and estimates. What the stock was down early in the day, like 3% in the morning. Why? Because they said specifically the high cost is beginning to eat into their margins, and their margins are coming down because they are not able to pass through the pricing power that they had before. That's going away, and the costs are rising. So that's pressing their margin. So again, I mean, Procter & Gamble is a key case. I mean, look, in a recession, I don't care what's going on. You're going to buy razors, you're going to buy toothpaste, you're going to buy toilet paper, those type of things. So it doesn't matter how bad the recession is going to get, you're going to set aside money to buy those. And that's where Procter & Gamble plays, right? That's their market. But they're even telling you, even in that market, in a recession, those margins are going to get squeezed. And so outside of that very basic staple environment, anything else that becomes discretionary has even more problems.
Yeah, no, totally agree. And we've talked a lot, on this channel about how we're kind of, I think, beginning to approach consumers' tolerance level, whether it's financial or just emotional, of like, I'm just not going to buy that at that price, or at least I'm not going to buy nearly as much as I used to. So, whether it's the cereal boxes that went up in price, but also had the shrinkflation so badly they can't even stand up anymore, right? Where you're like, I'm gonna buy this thing that used to cost me like almost half a couple of years ago. Now I'm just not going to pay that much. Or the case I've been using is the $33 BLT or the $27 cheeseburger. At some point, you just say, screw it. I'm just not going to pay it anymore.
No, my wife and I went on a date. My wife and I go on dates about twice a week, just to get away from the house and talk and spend some time together. And last night she said, "Hey, let's go have a steak." And I was like, "Great, let's go have a steak. It'll be awesome." Haven't had one in a long time. And so she's like, I even have a gift card that we can use. And so that was even better, right? So, but we started talking about which restaurant to go to. And in Houston, we have Perry's, we have Morton's, we've got Capitol Grill, which are, kind of all high-end steakhouses. And we went to kind of a local steakhouse, very mid-tier, because the cost is about 1/3 of what you'll pay for a steak at Capitol Grill or Morton's or somewhere else, right? And it's not a function that we can't afford it, but it's just a function. It's just, I'm not going to pay that much for a steak that I'm going to eat and not enjoy later, because I know it's going to give me indigestion when I get home, but it'll be fun while it lasts. But yeah, I mean, if I think that's going to be a common exercise. I think more and more people are going to go through.
Yeah. And so, for a lot of 2021 and 22, I think people were pretty amazed at how much of the cost of the inflation could be passed along to the consumer. But I think we're at the point right now where, again, people's tolerance level, whether it's emotional or financial, they're beginning to hit these limits of just like, you brought me to my pain threshold where I'm going to substitute, right? I'm not buying steak anymore. I'm buying tuna helper, or, or yeah, I need razors, but I'm gonna make them last, twice as long, right?
I saw, just real quick, I saw the funniest video this week as a lady's in a store and she's got her 3 teenage girls with her, and she's over by the refrigerated section, and she's got her phone out and she's taking pictures of her feet. And the daughter says, "What are you doing?" She goes, "I've got to figure out a way to pay for these eggs." And she's standing in front of the egg cartons, which are like $18 a dozen or whatever it is right now, right? So she's taking pictures of her feet to post them online so that she can make money to pay for eggs. But it was humorous, but that's kind of the problem that people are trying to figure out is, I'm running out of credit. I've tapped my credit cards as much as I can, and interest rates are going up on my credit payments. And food costs in a lot of cases are just getting out of control. And I've got to figure out a different way to pay for things.
All right. So I'm going to put up a funny egg meme too, just to respond. But I got to ask first, she's taking pictures of her feet. What is this like? Was this OnlyFans for people with a foot fetish or something?
Absolutely.
Okay. Now I get the humor. I was showing one to my wife the other day. It's of a guy at the beach proposing to his girlfriend, obviously. And he's got this crate of eggs instead of a diamond ring that he's holding up to her, right?
No, I mean, it's pretty much the problem, but that's the thing that we're gonna have to deal with. But that's going to be a thing that, again, back to Tom's thesis, that earnings are priced in and that the market's priced in. I think the market has priced in a soft landing scenario. So if you have a soft landing in the economy, things slow down a little bit, unemployment comes up a little bit, you have this kind of rosy, outcome for the economy, and the Fed starts cutting rates and doing these things. Yeah, I think the market has priced that in. I don't think the market has priced in an actual recession being mild or deep, and a deeper earnings recession where you see earnings decline to roughly about $160 a share minimum.
And by the way, Lance, I never realized you were such a bearish guy. But anyways, thanks. Just trying to dig.
But no, I just look at the data, and when you look at some of the data, I've got charts and all this stuff that I write articles about, but I mean, it just doesn't look great.
Yeah. No, I'm only teasing you because you're usually trying to bring me more to the bullish side of the story. All right, get a few more things on Tom Lee here, and then I got a bunch of other topics, so we got to really start chopping wood here. Another big bullish thing of that's on his radar is China opening up.
Yeah.
Hey, it's gonna surge the global economy.
Yeah, I don't have a good thesis for that. And what I mean by that is that, China's going to open up eventually, but they could shut it down just as quickly again. So, kind of betting on that outcome, we've seen them open up and shut down multiple times, right? So, if they open back up, there's a big resurgence, they're going to shut down again, probably, and maybe they don't. I think the bigger story out of China is to watch their credit impulse, how much they've got a big real estate problem, et cetera. So, one of the things, and this is, and to Tom's credit, this is absolutely on the bullish side of the ledger. If China begins a massive credit impulse to boost their economy, it's a very big input into the U.S. economy as well. So they bailed us out before, and they have back in 2012, we were in a manufacturing recession, but we never hit a services recession. And a lot of that was largely due to the big credit impulses that were coming out of China at the time. So, it absolutely can have a bearing. How much of a bearing? I really have no way to quantify that.
Okay. And then there's the question too of how much of this is already priced in, right? How much of the market's expecting from China. One thing I will say about how China came to the rescue after 2008, they are much more challenged to do so, at least in the same way this time around, because China didn't have a lot of debt back then, and it just wicked levered up in the decade plus after that. And they're having, some debt related challenges right now, like the real estate market imploding there. So they don't have the ability to sort of pull out the magic checkbook the way they did the last time around. Not that there aren't other strings they might be able to pull, but
I don't disagree with that argument. I think Japan's a problem. So
yeah, I mean, Japan's been a problem for a good while, but yes, getting in even more trouble now. All right, I'll combine these two together. He said, look, the VIX has been muted and falling, and it still looks continued to be on that same trajectory. That tends to be bullish for stocks. And then also he said, look, I think the dollar is going to be on a relative basis substantially weaker this year than it was last year. And that's going to add a tailwind to stocks. Thoughts on either of those two?
Yeah, two things. One, I've actually I've got a little piece I'm writing about in this weekend's newsletter on the website at realinvestmentadvice.com, talking about the term zero DTE. And I think this is a very important point to understand about what's happening, particularly when it comes to the volatility index. What is zero DTE? That is 0 days to expiration. In other words, what we're seeing right now, and I've been seeing this now with an increasing volume over the course of the last year, is speculators that are buying options that have less than 1 day to maturity. So what happens is if I buy an option, right? So I can either buy a put or buy a call, doesn't matter what side of the ledger I'm on. Let's say that I buy a call option on Apple. Well, so let me step back real quick explanation of what an option is, just so everybody has a kind of a base understanding. Adam and I want to do a transaction, and we write a contract between us. And I write a contract to Adam that says, Adam, I will buy all of your Apple stock at $150 a share if it gets there. And it's got to get to $150 a share by a certain date, March the 15th. I'm just throwing things out. So Adam agrees to this. I'm going to pay Adam for this right. And that's what an option contract is. It's just a right to do something. And so I pay Adam $5 for 100 share to buy 100 shares worth of his stock at $150 a share on March 15th. So that's what a call option is. Put options work exactly the opposite. There's a lot more to it. So don't start emailing me about options. Okay. If you don't know what an option is, it is basically just a contractual agreement to execute a transaction at a given date on a given price. There you go. Now, the problem is that if somebody has to write that contract, so if I want to buy a call option, Wall Street, whoever's writing that contract over there has to do the other side of that contract, which means they have to buy or sell those shares of that agreement to facilitate it, right? So all these zero data expiration options are causing a lot more of this buying and selling transactions to go on. And this is why we're seeing these days where the markets are up 3%, up 5%, down 3%. You're seeing these big swings that we haven't seen over the previous to about 2 years ago. We didn't see these types of moves. But these zero data expiration options are now a very big part of the total options volume. So what the hell does this have to do with the VIX? The VIX doesn't measure those. So you have all this action going on in the options market that is not measured by the volatility index. So the volatility index, and I'm not saying this is the case, but there is a thesis that the index isn't accurately capturing the fear and greed in the market because of what's happening in this non-measured area of the options market that's going on right now. So having said all that, it's just kind of an interesting phenomenon that's happening.
It is super interesting. Real quick, what's driving that? Why have all of a sudden everybody wants these one-day options? I mean,
$5 trillion worth of liquidity, and people figured out how to trade options. So this is all the speculators. So this is just, we saw this massive surge in speculation that started back in 2020, and it's just exploded over the last 2 years.
Okay. And I don't want to rattle on this, but you buy an option because you're betting that some outcome is going to happen. And of course, the more time you give yourself in buying the contract with the expiration date of the contract, the more probability you have, or the more chance you have of hitting that, right? A one-day option, I mean, that's like walking into the casino and just, slapping your number down the roulette wheel and giving it a single spin. Right?
Yeah, and that's what it is, because you're either going to win or you're going to lose everything, because when the options expire, it expires worthless.
Yeah.
But these options are so cheap, right? I can buy the thing about options are, again, let's go back to our explanation of options real quick. A option, so one option contract is based on 100 shares of whatever I'm buying. So if I'm buying one option contract from Adam for Apple, I'm buying an option to buy 100 shares of his Apple. So, but the contract doesn't cost me $100 times 150 shares of stock. That's $150. I'll spit this out. It doesn't cost me the full face value of the stock for the 100 shares that I'm buying. It only costs me a small little fraction. I may pay $50 in total for the option to buy, or $500 for an option to buy 100 shares of stock at $150. So there's a tremendous amount of leverage in options. Well, the shorter that maturity gets, and when you're down to less than a day, most of these options are trading in the pennies. So because there's what's called time to gain premium, don't worry about it, it's another issue. But as you get close to expiration, options expire worthless. So when you get down to less than a day to maturity, a lot of these options are super cheap. They're trading at 10, 20, 30 cents. So I can buy with a few $1,000s, I can buy a lot of contracts. And if that stock price happens to shoot up on earnings day or whatever it is, I can make a lot of money very quickly. And that's what investors are trying to do.
Okay. So does your gut tell you more that this is just money is still too cheap and these are just idiots that are just sort of throwing money away, speculating? Or is this more like big data, kind of like, what was it, Jerry and Marge Go Large?
Yeah.
Or Larry and Marge Go, I can't remember what the title was that you were telling us about, though, where if you've done the math right, and of course Wall Street's they've got big banks with super PhD quant armies, right? Is this sort of like a big data thing that if we just buy enough of these cheap lottery tickets, there's going to be a payout in there that's actually going to make it NPV positive for us?
Yeah, partially. A lot of this is algorithms, but a lot of it is just retail speculators as well. We're seeing a lot of retail speculation in options. So, it's people have kind of figured out this game. This week is a good example. I got several phone calls from people about Marathon Digital, which is a Bitcoin blockchain company, right? Bitcoin had a big run. It was up like 26, 30%, whatever it was. And Marathon Digital went from like $2 to $9 in just a couple of days. So if you were buying those options, you were making a tremendous amount of money on that run.
Immense, yeah.
Yeah. So if you can catch it, if you can catch one of these, Bed Bath & Beyond, yes, Bed Bath & Beyond is on the verge of filing bankruptcy. And that stock surged like 120% over 2 days. As they were announcing earnings and saying, we're probably going to have to file for bankruptcy, people were running that stock up because, again, you have a lot of shorts. It's easy to force a move. And this is kind of going back to that Reddit meme crowd that we saw before. It's not completely dead yet in the markets.
Okay. All right.
So real quick though, but we digressed back to Tom.
We did rat hole on this, but finish the hole.
So the point about the VIX is that right now the VIX is near lows. Tom is incorrect that a low VIX is positive for stocks. It's actually the opposite. A very low VIX normally marks the peak of a market because nobody's afraid of a crash, right? And that's when you generally get one, when nobody's afraid of anything. But again, one of the problems with the VIX is the VIX has remained the VIX never spiked up during the bear market last year. And a lot of it has to do with this 0 day to expiration option things we're talking about, which has been gaining momentum over the last year. But the VIX never really represented the fear in the markets that we saw during the decline last year. So I don't think it's really a good indicator to watch right now. There's some benefits to it. If you're a VIX trader, I'm not poo-pooing it at all. I think that may not be giving us as good of a signal as it used to. In terms of the dollar, there's a lot of things that impact the dollar. I think the dollar is extremely oversold technically. I think there's a bigger chance that the dollar rallies this year, particularly if the Eurozone falls into a recession, which I think is highly likely that they're not only be in a recession, but a deeper recession. And in that case, money is going to gravitate towards the U.S. dollar for both safety, security, and yield over what you can get owning a German bond or an Italian bond or whatever else it is.
Okay. All right. Great. Glad you snuck the dollar in there. Just real quick, back on the options thing, just for 1 second. If folks want to understand more about options, I just want to remind you folks that we did a free webinar a couple months back with the team from New Harbor that it's a nice hour-long explanation of kind of how they work. So if you want more than just the quick, summary we're able to give here, just go to wealthion.com/options hedging, and you can learn everything you want to learn about options there.
And if you want to lose all of your money, trade options. But other than
which is true, and of course that's a big thing we talk about, and obviously that webinar, which is they can be used very speculatively, which a lot of people have been using them recently, and really that's the fastest way to lose a lot of your money. But they can be used as hedges, as more like insurance to protect you on the downside, and that's generally the way in which we recommend that they be used. And we also generally say, look, if you've never traded them yourselves before and you're not very experienced with them, learn how they work, and then learn the language to talk to with your financial advisor to say, okay, how can I intelligently use these as hedges in my portfolio?
Exactly.
All right. Last point on Tom, and then I got to go to some other topics here. Yeah. He said that, look, really at the end of the day, I'm looking at the bond market and the bond spreads are low. They're not blowing out. The bond market's not worried here. And so, when I look at sort of where inflation is going and all that type of stuff, I think the bond market's got it right, that the Fed is being overblown here, and that, we're not really going to have many problems. So what do you say to that?
A fair statement. Right now, and we've said this before, right? If you take a look at the bond market, and what he means by that is you're looking at credit spreads, right? So you're looking at the spreads between corporate bonds and treasuries. You're looking at the spread between investment grade bonds, which are bonds rated triple B or better, versus junk bonds, right? Those rated double B or less. Those don't show any real risk in the markets, right? And nobody seems to be very concerned about anything credit-wise blowing up. So all that's telling you, though, is that the risk of a Lehman event is probably extremely low. But I will say this, is that prior to the Lehman event, credit spreads really weren't worried about much either. And then they were all of a sudden. And that's the problem with credit spreads. Credit spreads don't start to anticipate what's going to happen in markets. They respond to what's happening in the markets. So if the Fed does break something by hiking rates too much, by causing some type of financial strain, then credit spreads are going to reprice very quickly. But he is correct right now. That does not seem to be the case. That doesn't preclude us having a recession, though. Just because bond spreads are low doesn't mean we can't have a recession. It also doesn't mean that earnings can't come down markedly. It just probably means that we won't have a Lehman event or some type of major default cycle within the markets. And that's probably a fair statement, because we didn't do a lot of subprime loans for mortgages. We didn't do a lot of people overpaid for mortgages and houses, but they didn't take out a lot of subprime credit. So but there is a lot of risk in the credit market we're not talking about. If you take a look at the Russell 2000, about 30 to 40% of those companies in the Russell 2000 live on debt. And we call them zombie companies. And if they can't issue debt at low rates, they go out of business. So there is a risk that if we get into a deep enough recession and interest rates remain high enough, long enough, that they can't refinance their debt, we could see a default cycle kind of run through the markets. And it's too early to say that that's not going to happen right now.
Yeah. Okay. All right. Well, look, that was the bullish case. And it was fun to watch you kind of wear the other shoe today and say, okay, there are bullish arguments to be made, but here's the tempering on the other side of the scale. But it's good. That's what this channel is for, is really to try to look at all sides of an argument. So that was all great. Hesitate to ask this in case you have a lot to say about it, because otherwise we're going to have to go long. Last week, I mentioned the debt ceiling. You said, hey, let's hold off on that for a little bit while we get a little bit more data. Do you have enough clarity to say anything new about that, or should we continue to just be in look and see mode?
So first of all, I told you last week, you kind of caught me by surprise on that. And I was like, we just passed this $1.7 trillion spending bill, and I said then, I was like, I don't understand why we were having this conversation. What I missed, and when after we kind of hung up, I was like, oh, dumbass, I should have remembered that. That spending's to be debt funded, but anyways, go ahead. Well, no, we passed the spending part. We didn't raise the debt ceiling. Right. So we have the spending bill for $1.7 trillion, but we didn't raise the debt ceiling. So the government can't issue the debt to fund the spending bill. So that's the problem. Right.
And pulling that debt to try to fund it just has us hit the ceiling even faster. Yeah,
exactly. So here's a couple of things. First of all, don't worry. I can't tell you, Adam, I got so many emails this week is that, I was listening to Adam and you were talking about the debt ceiling. And so if they don't raise the debt ceiling, we're all going to die because we're all going to default. We're not going to die and default on everything. First of all, the Treasury Department has what's called extraordinary measures. They go borrow from the federal pension funds, et cetera, for a period of time to fund spending while they figure out what to do with the debt ceiling. We have been raising the debt ceiling. I think we're up to 23 or 25 times. I'm not sure exactly, but since 1980, we regularly raise the debt ceiling. Personally, if you're not going to honor the debt, so why do we have a debt ceiling? The debt ceiling is like your credit card limit. It is supposed to be a point, say, okay, look, you've kind of reached your credit limit. You really need to think about cutting spending and not issuing more debt. You're at your limit. And that's what the point of the debt limit was. It was to provide some type of buffer or some type of pause point to where you go, well, maybe we should think about cutting spending rather than, just spending a whole bunch more money.
Right. But Lance, this is American politics we're talking about.
I know. So the point is, and look, I used to be in the camp. People used to go, just get rid of the debt ceiling. We just need to get rid of it. It's an old, antiquated thing. We don't need anymore. I was like, no, we need to keep it because it at least gives you a focus that you're spending too much money, right? So it just at least makes you notice that you're 31 trillion and climbing on debt. So I think that it serves that purpose. But they're going to raise the debt ceiling. It's not going to. It's the Republican, Democrat. It doesn't matter. They're all going to raise the debt ceiling. It's going to be some financial wranglings over this, or political wranglings over this, over the next couple of weeks. The Republicans who have control of the House are going to try to extract some leverage out of the debt ceiling. We'll raise the debt ceiling if you do A, B, C, D, E, right? So they'll get this done. The Biden administration will chastise the Republicans for for vandalism, political vandalism, financial vandalism, whatever you want to call it, for trying to hold the government hostage over this. But let me be really clear about one thing too. You'll hear a lot of stuff in the headlines that if we don't raise the debt ceiling and we have to shut down the government, retirees won't get paid, the military won't get paid, we're going to default on our debt. No. The only thing that doesn't get funded during a shutdown is non-mandatory spending. Mandatory spending gets funded. That's interest on the debt, Social Security, welfare, military pay. All that gets funded, and we print money to do that. So all those people get paid. The non-mandatory spending, that's where we have. That's why when we had these shutdowns before, what do? We have to shut down the national parks, right? And so it's like, oh my God, it's trauma. People can't go to the park. I know it's a terrible thing, but that's what we start shutting down is those type of things. So the point is don't panic over the debt ceiling thing. It's not a good thing that we keep raising the debt ceiling. We should honor it. It's there for a reason. We need to control spending. I get all that, but don't go make financial decisions and go dump all your investments and go buy 100% of gold is gonna our debt. So. Yeah. Just you got to keep these things a little bit of perspective.
Yeah, no, agreed. To me, it's sort of like an airline strike on Christmas. It's just something that no administration will ever let happen. But the negotiations might get into the 11th hour on Christmas Eve, right? And so it's going to get raised. But the question is how much political kabuki theater is going to happen between now and then? To play a game of chicken between the two political parties. We'll be tracking it here.
It's going to be headlines all week.
Okay, so I want to get to a point I made last week, I think, and I think it was maybe not on this program, but on the monthly live Q&A that we did with our financial advisors. Where you had said that you think 2023 is going to be a weird year, and you explain why. So you were sort of calling it the year of the weird, and I said I agreed with you, but I said I actually think it's also going to be the year of the default, the year of defaults. And just after having sort of made that prediction, here's just a couple of very recent data points I want to share. One, that bank loss loan provisions are now at the highest they've been since 2013. So they're now at a decade-long, and actually they were higher briefly during the pandemic, but I kind of put that aside because we literally shut the global economy down. That was extraordinary, circumstances. This is more just sort of, steady as we go, current status quo economy, and banks are saying, hey, look, we're getting worried enough that we're beginning to ratchet our loan loss provisions up to historically high levels. Today, Discovery Financial Services, their credit card company, they just reported an explosion higher in their credit charge-offs. They're now up to about 4% from an average of more like 2%. They kind of hover, below or above 2% for the past bunch of years in the data set. Now they've just basically almost doubled to 4%. So credit cards are already beginning to see, okay, we're seeing higher default rates on our credit cards. You probably saw this, Lance, but KB Homes, which is one of the nation's largest home builders, they just announced on their fourth quarter earnings call that their cancellation rate spiked from 13% in Q4 of 2021 to 68% in Q4 of 2022. So over 2/3 of contracts were broken.
Yeah. And that costs money to do that, by the way. That's not free.
No. Yeah. So
people are going, I'll pay the penalty and I'll just not have the home. No, these are all very important points. By the way, one thing about charge-offs that you need to remember is that when charge-offs are done, so the bank sets aside loan loss reserves, and that's an expense to the books. When this passes, and just keep in mind, like Goldman Sachs set aside $900 million. When this passes, they're going to bring that money back onto their books, and that's going to boost their income. So when it comes back onto the books, it actually helps boost, their performance. So, when we get through the cycle, if
it doesn't get drained,
and we saw that actually happen in 2020, that was part of that explosion in financial profits. They had set aside loan loss reserves that didn't come to fruition because of all the stimulus checks and the moratoriums and everything else. So all that money came back on the books, and there was these massive jumps in earnings. So anyway, look, this is my whole point is that, this thesis of a soft landing scenario is very risky. I think the Fed has hiked too much. I think that's going to be a problem. I think the economy is going to slow down a whole lot more than people expect. I think earnings and margins are going to correct more than people expect. And markets are going to have to reprice. But part of that recessionary problem is going to be an increase in unemployment. It's going to be, defaults, charge-offs, bankruptcies, not to the, again, we're not talking 2008 financial crisis, right? But you're going to see an uptick in these type of activities because people are running out of money and they can't pay their bills, and they're having to make a choice between feeding my family or paying a credit card. And guess what? Credit card loses on that every time.
Yeah, and I just want to underscore here that this is pre-recession. This is pre-mass layoffs, right? So what we're seeing here is kind of the hangover from the stimulus party we had, where people were living higher than they really could afford to, right? They were living above their means. So we're seeing that people, the stimulus pig is largely through the python, and that people's prospects are not materializing as rosily as they thought they were, right? And so people are defaulting on bank loans, defaulting on credit card loans, defaulting on home purchases. And then I had that conversation with Lucky Lopez, that interview finally ran this week. Great interview. And he talks in there about how the delinquency rate in auto loans is just going through the stratosphere right now. And not only on the low end of the credit scale, but he said even the prime lenders, while their percentages are still low, I think it went from like 2% to 4%. It's a doubling. He said that is massively concerning, right? So, that's all coming from bad activity in the past. So a lot of the things that you just mentioned that we need to prepare for, that's on top of all this. That's all still to come.
Yeah. It's interesting talking about employment too. I saw a really interesting stat earlier this week that showed, what employees are getting hired. And this is something we talked about before, is that when employers go to hire people, they want to hire people that kept their job, right? Through the downturn, through the pandemic cycle, et cetera. And most of the hiring has come from companies that are basically poaching employees from other companies. And so the vast majority of the hiring has come from poaching employees, not hiring those that are unemployed. So a lot of these people that chose to just stay at home and live on stimulus, they're still having trouble finding jobs because they were out of the workforce, lost a skill set, and employers are going, do I really want you? You haven't been working in a couple of years versus this guy who's been employed the whole time. Maybe he's the better candidate.
Well, for sure that, and you and I have talked about, the epidemic of people that are checking out, and one of the long-term costs of that is your ability to get back in degrades very quickly for the reasons you talked about. But also from an employment standpoint, this is kind of like shuffling a little bit like deck chairs on the Titanic, right? Which is like, okay, so we're not necessarily losing an employer from the system yet, because he gets laid off at big company X, and smaller company that was dying for an employee like that finally gets him, right? But then if smaller company gets into trouble, then the guy actually leaves the system, right? And so again, it all depends on how bad this coming recession is. And I've got some job stats for a second. Maybe I'll go to them first, and then I've got an interesting housing one. So first, I'll do this in reverse. So we are continuing to see a steady drumbeat of layoffs in many industries, right? So yes, it's in tech. That's what's sort of been leading all this, but we're seeing it in media. We're seeing it in finance. At times, I've listed a whole bunch of companies that are kind of all over the map here. So the contagion is beginning to spread. I will put up a chart here, though, of layoffs in the tech sector, and tech is really generously described here, folks. So don't just think of it as uber tech companies. And you can see that the layoff wave now is substantially larger than it was back in 2020 when we were literally shutting the economy down. So to me, that is a really good visualization of the momentum that is building here. And I still think we're in the early innings of it. Microsoft just yesterday announced that they are laying off 10,000 or more workers. They're just one of the latest companies to announce 5-digit employee layoffs. What I think sort of underscores where we are in the story here is apparently Microsoft had sponsored a concert in Davos where Sting was headlining this the night before they announced these layoffs. So they do this big, glitzy, expensive party and then tell all the plebes, "Oh, sorry, guys, you're out of jobs," right? So it shows it's
great optics.
Yeah, it's horrible optics. And then the New York Times just came out with an opinion piece. They ran an opinion piece that said Twitter is just the start of the tech worker breakdown. And you and I have been talking about this, Lance, where if Elon Musk succeeds by keeping Twitter even just alive, in the next couple of months, after gutting the workforce by over 75%, he's really shown a new standard for, what an essential employee truly is. Because as you and I have talked about, in a lot of companies, a lot of industries, particularly in big tech, Silicon Valley big tech, there's been a lot of bloat. These companies have been very flush. They've been able to basically hire a worker primarily just to not have them go to another competitor, even if they don't know how they're going to use that person, right? So they've been sort of stockpiling or bullpenning talent. And then, of course, you just had people there that have had, director of fun. I'm the assistant deputy to the vending machine, servicer. A lot of that stuff's just gonna go when you don't have the profits there to afford them anymore. But the fact that we're at a point where the New York Times is now joining into this conversation, where up until now they've been sort of, on the everything is awesome team, I think is an important sign of where things are tipping. So I'll take a breath in just one second. The last point I want to mention here is sort of on the other side, which is initial claims are still pretty weak. They're still pretty damn low. And there is some questioning about, we had a bunch of storms recently. Maybe did that prevent people from going and filing for initial claims or whatnot? But regardless of the fact, it's those are not the numbers that Jerome Powell wants to see, right? The financial markets have been loosening of late, and now the job market is still refusing to basically show any increase in unemployment, which you said earlier is what Powell is trying to engineer here. So I take all those things together and say, Powell is definitely going to keep his foot on the accelerator, and that plus all the organic stuff that we've talked about just makes the job outlook for 2023 look even darker than it was looking to me last year.
I know, I agree with that, and just all those points are right. There's some issues about the jobless claims we've talked about before that they don't. There's a lot of variability happens in those numbers, so they can be very low, and then when they turn up, and it's like even unemployment doesn't go from 3.7 to 3.8 to 3.9 to 4.0. It doesn't climb like that. It goes 3.7 to 4.5 to 5.4. It's very rapid, and it's the same thing with jobless claims. Jobless claims don't go 190 to 200 to 210. It's 190 to 250 to 280 to 300, and it's very rapid because once you get to that tipping point to where you start getting real layoffs because of a recession, it moves very quickly through companies. Look, CEO confidence is at near record lows. That has never been a good outcome for employment historically. So unless somehow CEOs get a whole lot more confident about the outlook on the economy, you've got to still expect that unemployment's going to go up from here.
Okay. All right. Well, let's leave that rosy topic and head over to one of our other fun perennials, which is real estate and the housing market.
Yep.
I'll keep it short today. I just took one data point, but I live out in the San Francisco Bay Area. the latest data just came out for the median prices for homes out here. It's down 10% year over year. So we're now in a double-digit year over year decline. But if you measure it from the peak from last year, which was in March, it's down 30%, the price of a median home. Like, that is a very dramatic drop in a relatively short period of time. And I think we are still in the early innings of this housing market correction. So even I, who's probably been one of the bigger housing bears out there, I'm shocked that we've dropped 30% already in less than a year.
Yeah, and you're still overpriced out there. So
we're still way overpriced. Yeah, absolutely.
So, but look, again, we talked about this before, real estate is very location specific. So not surprising that you see a 30% decline here, but in Houston, as example, you might see 10%, right? So it just depends on what area of the country you're in. But no, we talked about this before. Here's going to be the thing that may frustrate housing bears potentially, right? And you saw this week, mortgage applications jumped 28% this week on a very small drop in mortgage rates. We went from like 6.6 to 6.4% on a 30-year mortgage. Now, mind you, that 28% jump is coming from extremely, if you have one mortgage application last week, you go to two this week, it's 100%.
100%, right? Yeah.
Right. So that 28% jump is based on a very few number of mortgages that are actually get written. But here's the bigger point of this. If you're expecting a massive housing fall off, and I'm not saying that's not going to happen, by the way, it's going to be a function of both recession, non-recession, right? Did you lose your job or not, right? I can't afford a house. I can't qualify for a house if I don't have a job. But the other thing is how fast mortgage rates come back down. So if the Fed does break something and they've got to cut rates back to zero pretty quickly, and mortgage rates go from 6.4 to 4.3, literally over the course of a month, we may see that bottom of the housing market come a whole lot sooner at a higher level than we would have expected otherwise. So,
all right. Great point. All right. Well, look, obviously it's something that we're going to be tracking, super duper closely going forward. But again, when we talk about sort of these shoes to drop, and I've said many, many times that housing is a very important one for a variety of reasons, but a big factor is that housing is much more widely owned than financial assets are. And so where the stock market goes really impacts people's psyche from a negative wealth effect, than necessarily what's happening in the stock market.
Yeah, no, and look, we talked about this, and look, I want housing prices to come down. I'm still looking for a new home, right? So I'm still renting and looking for a new place to live. So I need housing prices to come down even more. But what I'm doing right now is I'm just putting in lowball offers on houses that kind of sort of meet our criteria. They're not perfect, but they're generally in the right area. They're generally in the right structure. So I'm putting out lowball offers, and I've got 5 of them sitting out right now that are getting serious consideration. And it's interesting what the owners are doing. The owners of the houses are going, okay, I've got a cash offer in hand. So I'm not going to tell this guy no, but I'm going to wait to see if maybe I get a better offer.
Right.
And so they're going to wait. And it's like, and I told them, I say, here's my offer. It's cash. We'll close in 5 days and you'll be done with your house. But there's the offer, and it's good until you tell me you don't want it at all. And so they've got plenty of time to sit on it and hope to get a better offer. But if they don't, they know they've got a guaranteed buy at some point. So, maybe on one of these houses, I'll get lucky and get something cheap.
You get tripped. All right. Well, that's a good way to do it.
All right. I'll keep you updated on what happens.
No, don't worry. I'll be asking, and I'm sure you'll be getting a lot of questions that folks will be emailing you directly. All right. Well, look, can't finish one of these conversations without asking you about any trades that you might have done in the past week. Yep. What have you guys been up to?
Basically, we're starting to lengthen the duration in our bond portfolio. So one of the things we've talked about before is that we've, in our bond portfolio, that we've been very short the duration of our index. So when we look at the aggregate bond index, our duration of our portfolio is a lot shorter than the duration of our index. So as interest rates go up, it's not impacted as much. Now, though, we're pretty convinced that with the peak of inflation now we're also at the peak of interest rates. We're starting to change that allocation model. So we're starting to add in, taking a lot of our really, really short duration stuff that was like in floating rate bonds and 1 to 3 month treasury bills. And we're starting to move those up the ladder a little bit to 1 to 3 year treasuries. And then which will lock in some of these higher rates short term. And then as we get opportunity, we're going to keep moving up that ladder to 7 to 10 years and 10 to 20 years and begin to lengthen the duration of the portfolio. So as rates come down, we'll have a better price appreciation out of that side of the portfolio than we would just being in cash.
Okay.
And then on the equity side, we're just buying some kind of high quality dividend yielding equities in our portfolio just to create yield.
Okay. Any particular ones that?
We've had a long-term position in United Healthcare. Healthcare has been under a lot of pressure earlier this year, and it's very interesting. All the sectors that worked great last year have not worked this year so far. So, utilities, real estate, healthcare have all been lagging. Energy's been lagging this year. Technology and communications and all the stuff everybody hated last year has been really outperforming this year. So we added a little bit to our United Healthcare position. We also added a position in Altria, which has about an 8% yield on it. So just looking for it's got a great balance sheet, very stable, long-term. It's kind of a dividend aristocrat. So it's just got a real steady payout of dividend over time, and with an 8% yield. So this gives us a couple of stocks in our portfolio that yield well over 5%. So that's bringing up the overall income stream. Remember, a portfolio is built on 3 things. And this is why you want to own bonds in your portfolio, regardless of how aggressive you are or not. But the reason you own bonds is they give you capital preservation because they mature at face value, but they also provide an income stream. That's the first leg of your total return stool of your portfolio. The second is capital appreciation that you get out of your equities. That's what helps you outpace inflation over time. And then dividend yield is extremely important but that gives you the final leg of your total return. So you have capital appreciation, interest income, and then you have capital appreciation, interest income, and dividend income. And so those are the 3 return legs of that portfolio stool that you want to build. And so if you lack one of those, you're really kind of robbing yourself of potential return over time.
Okay. I think this one probably would have been in the capital appreciation bucket, but you tell me. Last week, you mentioned you guys were kind of nibbling in Goldman Sachs.
Yeah.
I think I didn't follow quite closely, but I think that did not have a great week. So give us the update on that guy.
Yeah, no, we added to our position in Goldman Sachs going into earnings. Their earnings announcement was not surprising. We expected them to report kind of weak earnings because of the investment banking side of what's going on. Obviously, a lot of IPOs are not going out, et cetera. It was weaker than expected, and the stock sold off a bit more. But we're still positive in the position because we averaged up into the position over time. We still like the company. We've got a fairly short stop on it right now, but we're holding it for the moment. But I think that it's going to be okay. But that is in our sell candidate bucket right now because of performance. So it may get sold here in the next week or so.
And did you buy it for appreciation potential, or does it pay a nice dividend? I haven't looked at it.
No, we needed finance. We didn't have any financial exposure at all in the banking sector. So we needed to add, and again, we had a very small position in Goldman Sachs. We traded it a couple of times last year and had brought it back. We had traded it, sold it at a profit, brought it back down. But we were really underweight financials going into this year. So we had a choice of either like buying a JP Morgan or buying something else and adding it with Goldman Sachs. But we just added to our Goldman Sachs position, which now I wish we'd have bought JP Morgan or something. Things don't always work out the way you want, unfortunately. But it was really a function of portfolio weighting. You don't want to be completely devoid. Like we added to energy recently because we had sold out of all our energy stocks at the peak of the energy market last year. And we had no energy exposure. So if we do get a run in energy prices this year, we would not participate with that. So it's always important to have an allocation mix in your portfolio, diversification. And so the reason that if I had my dithers, I probably wouldn't own financial, but we need some allocation in there in the portfolio just for diversification purposes.
Got it. Okay.
It's only 2% of the portfolio, so I mean it's extremely small.
Yeah. But hey, look, and not everyone's a win. I asked you specifically about it because it wasn't a home run, and we got to talk about the strikeouts sometimes too. Although that's not a strikeout, that's a TBD.
Yeah. But that's a great point, by the way, because normally when you talk to people, they only tell you about your winners, and look, we have losers, so it happens.
Yeah. All right. And I just want to reiterate too, or point out that on the energy side of things, having sold most of your big oil majors and stuff back near the highs, which was great. I just launched a video today with Ted Oakley, who is another Texas-based financial advisor. And Ted basically did the same thing. And like you, is now beginning to kind of re-add exposure back on there for all the reasons that you said you were. But it's nice to see that you guys being in Texas are real close to the heartbeat of that industry, obviously, and you both seem to have timed it quite well. All right, so in beginning to wrap up, I'll get to our little rant in just a second. We'll make it quick, and it won't even be a rant. It'll be something positive. I want to just do a little preview and get your thoughts on this, Lance. So I just recorded a great interview on a topic you wouldn't think would be really engaging, but it totally was, which was the topic of taxes. So I talked with Tom Wheelwright, who is about as close to an A-list celebrity as you can get to be in the accounting world. Robert Kiyosaki, the Rich Dad, Poor Dad author, he has a bunch of Rich Dad advisors on a bunch of key, financial professional areas, and Tom is his advisor for tax. And so we had a fascinating discussion of basically the framework that he uses to say, okay, we have a tax code that's ridiculously thick. I mean, literally tens of thousands, if not hundreds of thousands of pages. And he said almost all of it, are basically just incentives for how to save money in taxes. It's just what the government, is willing to give you a deal if you put your capital to work in certain ways, right? And he said, so if you're a good accountant and you know what's in there, they basically give you the recipe book for winning the game, right? And a good accountant should sit down with you and say, okay, given what you're doing, I can save you, money here and X, Y, and Z. But if you're open to doing these other things with your money, I can save you a lot more going forward, right? So it's pretty phenomenally impactful when you marry a really smart accounting strategy with the financial advisory side. And I know from having talked to a lot of financial advisors, they're always kind of hamstrung to a certain extent in being able to recommend CPAs to their customers, for the main reason is that if you're like RIA, you do business in almost every state. And when you're working with a CPA, ideally you want one that understands, the tax law in your state. So it's hard for a financial advisor to have, 50 different accountants that they can recommend, right? So I'm kind of excited that the ability to one, just educate people on what can be done here with smart tax management. But also, I'm just curious on your thoughts about the marriage of a really good accountant with a really good financial advisor.
Yeah, no, it's crucially important. I personally have an awesome accountant that, saves a lot every year. But but real quick, this is also the whole fallacy about tax the rich, blah, blah, blah. 90% of the taxes are paid by your top 10% of income earners. The bottom 30 to 50% pay no taxes or actually get back from the government. And so we hear all these stories about, well, so-and-so didn't pay any taxes last year, and XYZ didn't pay any taxes last year. And that's why companies like General Electric and IBM and Amazon, they have entire accounting departments that are nothing but people sitting around looking through tax code, figuring out how to take advantage of the game. Donald Trump is famous for, saying this. He's like, yeah, I didn't pay any taxes, but don't hate me. Change the tax code, and then I'll pay more taxes. And that's really what this comes down to, is that we've got this tax code system that is so laborious in terms of the number of rules and regulations and all this stuff. Even the IRS agents don't know the tax code completely. There's these things in there. And that's why you have really good tax accountants that sit around all day and fight the IRS. When you get audited, they say, oh, no, there's code number 123 that says this. And, and that's how you fight these things. But, the bottom line is this is why a flat tax or a fair tax is a better solution. than having the tax code that we have, because it would, but you would penalize poor people because they'd have to pay the flat or the fair tax. And so everybody's going to get upset over that. But at least everybody would pay tax at that point on what your income is. But as long as you're going to maintain this tax code, don't hate the player, hate the game. And if you and so don't complain about people not paying taxes until you're willing to complain to your legislator to start actually changing the tax code. And if you really want everybody to pay their fair share, go to a flat or a fair tax, and everybody will pay their fair share.
All right. Well, you said you were throwing your hat in the ring last week to run for president, so this can be part of your platform. Get a lot of people that'll vote for that flat tax.
I'll fix the tax code with a bottle of lighter fluid and a lighter. So
yeah. And look, I'm in full agreement with you that if you could, probably one of the easiest, quickest changes you could make is just say, let's toss out this incredibly, arcane set of rules and let's just replace it with a simple percentage.
Just think how much money we could save budget wise on getting rid of the IRS too. So
and what people, I should have pulled the stat in advance, but just what people pay in tax preparation these days. I mean, it's ridiculous how much I pay in tax preparation for until now services where I've kind of felt like, is this saving me really much more than just using TurboTax right now, right?
But also there is also why it's just like the healthcare system. Why we can't fix the healthcare system is because there's too much money made in the healthcare system. The same thing.
Absolutely.
The reason you can't get a flat tax or a fair tax to go through is because of all the accountants, the lawyers, everybody else that benefit from the tax code. That's their whole business. TurboTax wouldn't exist with a flat tax.
Well, and all the corporations that would lose their tax benefits that th've structured over time, and everybody's going to fight it. That's where I'm going with this. Is it's like the Rumsfeld quote. Look, you don't go to war with the army you wish you had, you go to the war with the army you have, right? It's just the tax code that we have here, which again, I think is so important to have a really good accountant that both understands the code and how you can use it, but more importantly, is a proactive agent for you that comes to you and says, this is what I can help you do if you're willing to change your behavior. Where I got to say, I've paid a lot for accounting services over my life, and I've had what I would say, I think are pretty good accountants in terms of they seem to know the code well, and they look at my returns and say, okay, here is a good legal way to file them. But I've never gotten that proactive, like, oh, well, Adam, look, given your particular situation, if you bought some real estate property over here, I could give you this deduction. Or if you owned this type of tax advantage asset here, I could give you this additional deduction. And Tom talks about how you can kind of layer deduction upon deduction upon deductions. Really cool stuff. So hopefully I'm making folks interested in going and watching the video when it comes out next week. But one thing he said that I want to get your reaction to, Lance, before we move on, is he said, everybody sort of thinks about sitting down with their accountant at the end of the year, dumping all their information on them and hoping that the accountant can save them money. He says, end of year planning doesn't do you any good. It's too late to change anything in the year. All we can do is just compute the numbers as they are. If you sit down with me in January and we create a plan for the year, I can save you way more money in the next 12 months, right? Yep. And I think it's very similar with financial advisory services too, right? If folks sit down with your team at January to come up with a plan versus sitting down in December to say, okay, well, here's what happened this year. What do I do?
No, absolutely right. I mean, Roth IRA conversions and RMDs, when should you take them? How should you take them? Those type of things. If you wait till and look, I was on this channel and on our radio and on our YouTube channel, daily. The entire month of December is like, don't wait till the end of the year to do tax loss harvesting, tax loss planning. Do it now, right? And regardless of that, we had a slew of people show up 3 days before the end of the year going, okay, I need to open a Roth, right? It's too late. Done. You can't, everybody's booked, right? You just can't get it done anymore. So, but you start at the beginning of the year and you start laying out your plan. What investment am I going to make this year that's going to give me a tax benefit later this year? When do I need to take my RMD? How do I need to take it? When do I need to do my tax loss harvesting? All those things can wind up saving you a lot of money in tax dollars if you plan ahead. But that's, problem is most people don't plan.
Right. All right. Well, hopefully folks will be inspired to after watching this video with Tom Millwright that's coming out next week. All right. So just to wrap things up here, I'm going to show a brief video clip while we're talking here, Lance, and some might call this a humble brag, and maybe my wife would agree. But
Right. Okay.
yeah, but this is me delivering upon one of my New Year's goals, which was yeah, I've had my home gym. I've been working out. We talk about the importance of investing in one's health here on this channel. That's a very important, maybe the most important form of wealth. And one thing I had not been doing, especially because the weather had been so crappy out here for so long, was really doing pull exercises. And so I said, look, I want to work on pull-ups. I'm going to add that to my repertoire and really start getting good at them again. So I set myself a goal of doing 50 pull-ups, which would be 5 sets of 10 pull-ups each. So the clip I played here is, it was the other day I hit that goal. I think this particular video was the second set of 10 that I did. And I just sort of put it out there on Twitter as a, hey, hit a goal, wanted to share it with you. Hopefully maybe inspires some other of you desk jockeys like me that you can actually still do some of this stuff, especially when you're over 50, like both you and I are. And Lance, I know that you're big into fitness as well. So, I guess I just want to share it here to let people know, and again, maybe encourage, inspire some folks who've been thinking about something like this, that, if you set a goal and you just are focused and disciplined, your odds of hitting it, are much more likely than it just remaining kind of like a dream in your mind, right? And yeah, you got to do the hard work, but if you do it day after day, it took me a while to get back up to this level here. But it paid off. And that's one of the things I love about fitness is it's very visible and tangible. Your progress is, you can literally count your reps, right?
Yeah.
The other thing though that was interesting was there were so many people who responded to that on Twitter. It's like definitely one of the most popular tweets I've ever had. And most people were super kind. In fact, almost everybody was super kind. Some people gave some great tips, and yes, I know my form can continue to improve even more than it was here. But a lot of people saying, oh gosh, well, I could never do that, or man, I could only do one, or maybe joking about, I could do pull-ups if I'm pulling up, a sub sandwich to my mouth to eat it or something like that, right? And it was sort of this sense of like, I can't do that. Right. And for so much of life and so much of goals in general, but certainly so much about fitness, so much of it is attainable. Starting from zero is hard. And pull-ups are a great example with this, right? Getting one pull-up when you have none is really freaking hard. It takes a lot of work. But once you have one pull-up, getting 2, light years easier. Right. Once you have 2, getting 3, way easier. Right. So I just sort of saw this as like a parable for life. And I know that you've lived your life a lot this way, Lance, so I figured you would have some inspiring, perspective on this to guide folks out of this conversation.
Well, no, I think, let's flip, since this is a finance show, let's flip this back over to money. It's the same thing with money, right? The reason that most people don't look, there's, we talked about before, everybody's got a bad taste of capitalism, right? It's not capitalism that's broken, it's corporatism and other issues. We've talked about that before.
Yep.
But capitalism is there and it'll work for you, but you've got to go out and you've got to do the work. You've got to take the risk, and just like doing exercise, right? You've got to get to the gym every day. You've got to do the pull-ups every day, or whatever it is that you're trying to achieve. You want to squat, 315, whatever, you can do that, but it's going to take time and effort to get there. And the work sucks. I mean, let's just be honest about it. Nobody likes, doing the work.
Hey, sorry to interrupt, but just in that one point, like, not only does the work suck, but you're going to suck at it initially. Right. Like,
exactly. Which is
discouraging. You got to mentally just prepare yourself. Right. Because so people get down to themselves. Oh, I look like an idiot, or this is such a low weight, or whatever. Right. The only money I can put away this week towards my savings is too little. Right. It's like, no, you got to start somewhere. Right.
And that's exactly my point. And so, if you want to build wealth, the road to $1 million will take you a long time. Once you get to $1 million of wealth, 2 million comes very quickly. Once you get to 2, 3 comes even faster, because now you have the power of investing in things and compounding your growth rate and doing all these other things. But, when you say, invest to get to $1 million, it sounds like, that's just inconceivable that I could save $1 million. But you can save $1 million just putting it into a bank account. You just got to be committed to doing it. And when you start looking at how much money you waste, if you sit down and do a budget, and this is the thing, nobody wants to do a budget. But if you sat down as part of your process and just did a budget and look at all the money you waste on a weekly basis, buying Starbucks coffee or going out to eat, or doing whatever it is that you want to do. When you look at how much money you waste versus taking that money and investing it and buying a piece of real estate that you can turn into a rental property, or investing into the markets, or a whole variety of other investments you can make, that's how you start building that wealth. And yes, it's a slow process, but I can take $10,000 and I can leverage that into a rental property and create $100,000 of net worth. By doing that, it's paying me. I then have that income stream that I can go out and buy another piece of rental property and leverage that there. And then I can be investing my cash flow into the market, leveraging that money in the markets. Then I can use a whole life insurance policy to leverage even more. I mean, there's just so many things you can do. And then once you start kind of and this is kind of back to the accountant issue, once you start layering these things in, all of a sudden you have these multiple streams of income that are compounding themselves, creating more opportunity. So all of a sudden that $1 million becomes very quick. And then the 2 million comes much quicker. But it's the same thing with exercise or eating right. This is the worst time of the year to go to the gym because everybody's in the gym with New Year's resolutions. I can't wait for February because they'll all be gone and it'll be back to my core group. So, but this is the problem. Out of all these people that show up for New Year's resolutions, my core group will be there in February +1. About every year, we pick up one new member of our core group that starts in the new year and actually gets the habit together to begin working out on a steady basis. But that'll be one out of about 50 that'll join our core group.
All right. Well, look, hopefully your words here are inspiring some viewers here to be some of those folks that actually persevere and kind of get the critical, the escape velocity of their momentum to be able to actually, go and start hitting their goals, whatever they are. Your point about the budget of the people that flame out in the gym reminded me of another thing I tweeted out the other day. At the time, I didn't realize that this was a lyric in, I guess, a Kenny Chesney country song. And I guess there have been variants of this all the time, but it was a great quote. It said, "Everybody wants to go to heaven, but nobody wants to go today." Right. and I really took that as everybody wants the dream, but nobody's really willing to start the hard work today to do it, to take the pain today to make it happen. All right. Well, look, let me land the plane here. So I want to remind folks, I mentioned this briefly last week. I'm going to plug it again. We have locked in the date for Wealthion's next conference. It's going to be Saturday, March 18th. The details of that are going to be coming out very soon, probably just the next couple of days to the alumni of past events. And then after they've had a chance to get first crack at tickets, we're then going to open it up to the general public at our early bird price. So more details on that to be coming very, very soon. Lance did a better job than I could this week explaining why it's such an important time to work with a financial advisor who really understands and takes into consideration all of the macro issues, both bearish and bullish, that Lance and I talked about today. If you've got a good one who's already doing that for you, great, stick with them. They are super valuable. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and his team there at Real Investment Advisors, why don't you go schedule a free consultation with one of the financial advisors that Wealthion endorses. Again, it's totally free. It doesn't cost you anything. There's no commitment to work with these guys. It's just a free public service they offer to help people make more prudent decisions around their wealth. To go set up one of those consultations, just go to wealthion.com, fill out the short form there, and our advisors will be in touch with you very quickly. And last, if you are continuing to enjoy this series of weekly market recaps, even a subatomically small fraction of as much as Lance and I enjoy doing them every week, please do me a favor and support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, I'm going to give you a chance to say anything you like to walk folks out here.
Look, this is going to be a very interesting year. I have no idea how this is going to turn out one way or the other. So, we'll just, again, like we said last week, the word of the year is going to be audible. So we'll just every week, we'll keep you up to date.
All right, Lance. As always, buddy, great week here with you. Thanks so much for coming on the program and sharing so much of your time with us. Everybody else, thanks so much for watching.